And joining me right now is Kiran Morzaria, CEO of Cadence Minerals, KDNC's ticker. Kiran, thanks for joining me.
Thanks as always, Justin. Good to see you. And a happy new
year. Happy New Year. I know it's still in the early days of 2023, and of course we'll be discussing what you're hoping to achieve this year. But you've also achieved a lot in 2022, including the completion of the PFS on Amapa. There, we'll discuss that. So let's look back and then we'll look forward. So if you could just take us through what's happened in 2022, Kiran.
Yeah, absolutely. This slide here just shows a summary of our major assets. I'm not going to focus on our little trading portfolio because we have very small stakes there. They have performed well in terms of overall returns. Of course, 2022 wasn't a great year for stocks generally. But if we look at those assets, the ones in grey are the ones that are private assets. And we can go through each of those and what we've achieved, which are Amapa iron ore mine, which we did our PFS. The Mexlit, which is a Sonora JV, which is a really positive asset and has had in 2022, there was quite a lot of issues around Mexican nationalization of lithium assets. And then we've got European Metals holding Hastings Technology and Evergreen. So really, I'll be focusing on our achievements, and our targets for 2022 were on really Amapa, Hastings and Evergreen, and we can talk around the rest as well. So Amapa, well, I think, I recently did a podcast. If you remember, we got involved in this asset when it was in receivership. It was in a relatively horrible state. We had to take it out of receivership, but we saw the great advantages. We saw what's confirmed in this PFS. It's got an integrated mine, railway, and beneficiation plant, which it owns entirely, and has concessions of. And that PFS has resulted in an NPV of just under $1 billion, but $949 million over a 16-year mine life. We've got a maiden ore reserve, which it never had, of 196 million tons. And that the NPV and the economics mean that we'll have around an EBITDA of 235 million a year, average over the life of that 16 years. So last year, one of our objectives was to get to 27%, which we did, and we increased it to 30%, investing $9.3 million in total to get 30%. Given the NPV of 949 million, that's still matching our investment criteria and returns that we look for across all our assets. So it's an integrated asset, which is quite rare in an iron ore mine. Often people have to ship a third-party rail and a third-party port, and that really makes a difference to the cost structure. And also strategically important, that whole area, if you look at that map from where the railway goes, from around along that area, specifically the area that's going northwest, is a band of other iron ore assets. And Anglo identified historically, potential of another 1 billion tons of iron ore. Obviously, these are not our licenses, but it shows that given the concession, we can actually export those and use that as an additional commercial revenue. But that's outside of the NPV. So the next slide really just shows, I think, a real summary of where we are, what we own. So all the geology, mining, processing, rail and port. And we've got, as I said, a 16-year mine life, 196 million tons of reserves, a processing route, again, de-risked. We'd already knew that processing route was de-risked, so we don't have any of that risk of processing. We just have to rehabilitate the mine, port and railway. And that we've estimated about $400 million. The large chunk of that is both in the port and the beneficiation plant. The port mainly because one of the reasons that this asset is where it is there was a failure in the port, in the retention walls of the port, and that stopped it exporting. Didn't stop it producing. It was still producing around 5.5 million tons. But as soon as you have that limiting and constraining factor of the port, you are unable to generate cash flow, sufficient cash flow to support the mining operation. So in essence, because it didn't have enough cash at the time, it basically went into receivership. So there was our advantage. So that's going to cost, I think, in direct costs around 113 million of that 399. But we'll just talk about that in a second. There are some things that we want to do next year that hopefully improve that capex, and also talking about resources, maybe improve the resources. And the OPEX is very much what we previously quoted, around the $35 a ton free on board, and $64 to China. The product we're producing is 65% material, majority of it, 65% material, and that will fetch, in our model, it's about $120 a ton. The average is about $114 over life of mine. So it's a substantial margin, hence delivering the NPV, hence delivering internal rates of return of 34% and a 4-year payback. So and when we talk about a low capex, I think people say, well, $400 million, that's a lot of money. Well, if we take a similar iron ore deposit, the mine alone and the beneficiation plant will cost about $100 per ton of production. So in this case, it would cost just the mine and the beneficiation plant around, and this is standards across many other deposits in Brazil and outside, around $530 million to develop an asset like this, just the mine and the beneficiation plant. Forget about the railway and the port. In Brazil, outside of Brazil and Canada and Australia, that can run into $600-700 million. So we get the entry point at a much cheaper price, but the benefit upside, and hence improving that NPV substantially. So really, that's where we sit with Amapa, and it's really positive and fundamental key point for us now is to progress to the next stage. It also, this PFS really provides us now with the springboard to engage with potential off-takers, potential financiers for the DFS, and possibly the debt starting the debt funding discussions once completion of DFS for construction. So that's where we are with the Amapa.
You must, but Kiran, nothing ever runs smoothly in business, especially when you're dealing with different, jurisdictions and different organizations. But you must be pretty pleased with how it's progressed in 2022, haven't you, Amapa?
Yes, very much so. At the beginning of the year, I was a bit reticent in talking about timings of the PFS because people think it's just a simple process of going through stages. But along the way, you will find things are outside of control, new legislation. You've done a bit of investigation and found actually this whole area needs a redesign, or so that takes time. It was only at the latter end of last year where I was confident talking about being able to publish this because we had a very clear idea. So I think for a PFS, this is quite quick to get it done. The next stage is going to get the DFS, and a lot of the study is already done at a DFS level. So I'm really pleased with the progress of Amapa from when we took over it, when we sort of invested in it. Yes, the banks created a delay, again, external factors which can affect us. But as a whole, when we take it how we've acted and how quickly we've acted and implemented this study has been excellent. So I can only congratulate the team, both at Devon, both at Indosino, and Cadence for really working hard to get this done. So we're really pleased with that result.
Okay. Well, listen, we'll talk about what you hope to achieve in this year, and also maybe ask you, what shareholders are asking you about it. And but okay, let's go to the next project if you could, Kiran.
Absolutely. Evergreen. Now, I think a lot of this sometimes goes a bit under the radar because it was a relatively small investment. If you take this investment, we invested a long time ago, and we ended up with some concessions through various transactions in this lithium hard rock province. Now, if you know anything about core lithium, it's just started. It's right adjacent to core lithium, and core lithium is just starting its first export of this hard rock spodumene. Spodumene is the precursor, much like iron ore is the precursor to steel. Spodumene is this precursor that's shipped to China, and China produces these products which are used in battery metals, lithium hydroxide and lithium carbonate. And that's, right next door to 2 kilometers away from core lithium. And that's got a market cap of 1.9 billion Australian dollars. Now, we've done very little work. It's early exploration. And we got satellite imagery and geochem signatures that really actually provided some really interesting results. And as a result of that, we basically sold our stake for a stake into Evergreen, and that's going to become public. It was meant to become public at the tail end of last year, but a lot of ASX companies were coming public, and there was a bit of a backlog. We don't have to contribute. They've already got 4 million. They've already got cash in the bank. They're raising some more capital on IPO, and our stake at this point in time is about 13.2%. It will reduce as a result of dilution, and if they're successful, we'll get £3.8 million worth of shares in this on the back of an investment off the top of my head is about £700,000. So it's again a good return, already booked in our financial results. If they're successful with drilling and they're able to prove something similar in size, that will be exceptional for us, and a substantial upside for us. I would say that these sort of deposits are much quicker to prove up. There's not very much processing technology to deal with. It's close to a port. The infrastructure is established, so it's not as difficult as maybe doing a full lithium project that goes from extracting the material and producing a final lithium carbonate and lithium hydroxide. The market at the moment is still quite. In the beginning of the year, we were talking about $40,000 per ton for lithium carbonate, lithium hydroxide. At this point in time, it's sitting at $80,000 a ton, so it's doubled in price. Yet people have sold off lithium stocks generally, partly because there's probably an anticipation that pricing will change over the year. But nonetheless, when we assess these assets and their potential, when we go to a couple of the other assets that we've got lithium, we look at about we assess them. We looked at a $20,000 or $12,000 a ton lithium carbonate pricing. So even if this was to drop off, lithium pricing was go back down to 40, it's still an excellent asset, potentially an excellent asset. And we will look forward to their listing and their exploration, which they, as part of their listing, they're raising that capital to start that drilling and exploration, hopefully in the coming year.
Yeah, and lithium, like I said, there is worry about global recession, and with that, comes the prospect that less cars will be bought, electric vehicles and all that stuff. But that's very much a temporary dip, isn't it? I mean, because let's be honest, the long-term profile for lithium very strong. I mean, I can't see, where are we at? Less than 5% of the cars on the road of electric vehicles, and so that's got a long way to go, isn't it?
Yeah, it's. We've been talking about the potential for huge penetration for a really long time, and hence when you look at some of our assets, we've been investing in them since 2016, 2017, and they've performed well over that time with occasional dips and turns. But the fundamental driver, as you rightly pointed out, is electric vehicles. That is where the majority of the demand is going to come from. So even though, let's say we have a recession, there is a baked-in aspect of people having to renew their cars because they're on leases, a lot of them. And whether people then have to trade in, and do they go for an electric vehicle? I think the majority of people will, because they're looking at in the UK 2025, people will say, oh well, we have to have a electric vehicle and the advantage associated. So we're not so worried about the change in consumption of electric vehicles because of vehicles as a whole, because the proportion of that change, we're going to have more and more electric vehicles, and therefore we'll still have a continuing demand. There is incredible shortfall. Benchmark Minerals, even taking into account a recession over the next, I think it was the next 5 years or 6 years, estimated across all aspects, across cobalt, nickel, lithium, and manganese, which are the key point of an NMC battery or a lithium battery, represented, they estimate about over 370 new mines would have to be developed. And mines don't take, they're not just, oh, found it, let's drill it. As you can see with, big majors will take 10 years to discover, develop, PFS, DFS, finance, and construct. But so we are going to have a shortage. And I think the biggest problem that we'll find is that the demand is not going to be capped by people wanting more. It's going to be capped by the availability of the products. So as much as we saw through COVID, car prices car prices went up in secondhand because the microchips weren't available. We're going to see the same thing with people being able to buy so much of lithium vehicles or electric vehicles because of there will not be enough supply. But I said that 3 or 4 years ago because people still weren't investing. And we tried to do our part by investing in projects and getting them off the ground through that early stage of the high risk area. And we've been successful in that regard so far.
Yeah, I don't know if you saw, vehicle registrations in the UK came out, and it's down. Registrations are at a 30-year low. But what's interesting is now electric vehicles account for a fifth of all registrations, and that's gone up from 190,000 last year to 267,000. It's gone from 11.6% to 16.6% of the market. So that is growing, even though the market is largely down to the registrations were down to supply chain issues and all that stuff, and maybe cost of living. But of that smaller market, the EV market is getting bigger, and it'll continue. I mean, of course, when we'll hit tipping point, I don't know, but it's not going to slow down. It's going to continue, and so the fundamentals behind lithium, very good, aren't they?
Yeah, it's not a change in. We've talked about commodity cycles and how they go up and down, but that's assuming technology stays the same. This is effectively a new commodity super cycle because there's a completely new use, relatively new use, or mass use for all these commodities that weren't needed 4 years ago. So there's a massive expansion in lithium, cobalt, nickel not so much, but nickel and manganese to a lesser extent.
Yeah. Okay. What's next, Kiran? What happened in 2022?
European metals. I'm really not going to say much about this because this is ultimately we still hold our stake in this, so an equity stake solely. I am on the board as a non-executive director, seeing how it progresses. But they're advancing through their DFS, through the hard yards of DFS, and subsequent to DFS, they will look to get financing through debt and equity. I think European metals, its assets strategically are located in Europe, where we're looking in terms of the second largest battery manufacturers, in terms of mega factories or gigafactories, as they call gigafactories. They're occurring in Europe. So it's China, Europe, and USA. So Europe is the second largest place where you're going to get all these gigafactories being constructed or are being constructed. So it's a strategic location, and it's producing a final product. It's not producing like Australia, that precursor, the spodumene. The plan is to produce a lithium hydroxide, which goes directly into battery packs and then directly into cars. It's also got a great JV partner, which owns 51% of the which is SES, which is a dominant utility company in the Czech Republic. But let's see what they do. We would hopefully be able to hear some updates in terms of their DFS during this year, but that's for them to announce and guide us on.
Yeah, excellent stuff. And next?
Hastings. Well, this is one of those ones where it was a slow burner. We've invested in this for a non-contributory amount. Again, it was about £900,000 in cash and equity a long time ago when we were actually called Rare Earth Minerals, and this is a rare earth project. And these rare earths are used in permanent magnets, again in electric vehicles. And we had effectively a part of a license, a 30% part of a license that was going to be mined much later in the mine life. So we basically swapped it out for an exposure to the whole asset, and we basically sold it for £5.1 million, which is going to be satisfied with Hasting stocks. And the last precondition to be met on that is effectively the transfer of those licenses that we have a 30% stake in into Hastings, and that's just taking time in Western Australia because, again, they've got a backlog of all these transactions. But otherwise, all preconditions are done, and we will have £5.1 million of that stock, in this year. So when we have both Hastings and Evergreen, when you take those two together, based on our initial investment and now our return, is going to be around. So I think it's about 380% return on those two investments, based on the pricing that we're discussing here.
Yeah, so it is funny looking at, we're in a bear market and how stocks have sold off. And if you look at future potential, like, for example, you're well placed, so the growing EV demand, but, just the valuation of your company right now compared to where it could be or should be,
Yeah, I think it's really hard to explain when you have and worked really hard to get these things done and delivered them. And delivered really good results, and it's disappointing to see the results in the market. And I suppose I think that is an element of a risk-off approach, and AIM is retail-based. Our institutional base is small, sitting at around 7% of the company, plus plus management, and no one sold off, and we bought in last year. So the fundamentals and our support there is that in a retail base, we're getting people that obviously have pressures or want to have a risk-off basis, and our announcement, one which WH Ireland put a substantial value to what we would attributable to our share price, wasn't reflected. And I think that's it's a liquidity event, and people take advantage of those. That's the only way that I can rationally explain it in what sometimes feels like an irrational market.
Yeah, no, it is irrational. I mean, there are people, we've been risk averse for so long now, and I say you see any liquidity event, which could be very good news for companies I've seen sold into massively. So it's just sentiment, isn't it? It'll change, and people will probably be buying stock a lot higher than they sold it at. So come the turn in sentiment. But okay, what's next, Kiran?
The last one is Sonora, and I think this one is probably, look, it was bought out by Ganfeng, which is the third largest lithium compound producer in the world. It's a huge asset, multi-generational. The DFS, definitive feasibility study, it's a bit like Hastings. We have an area which you can see that diagram, the Fleur pit, which is an RJV, and that gets mined in years 8 to 19 under that DFS plan. However, Ganfeng have informally in the market talked about they want to increase production to about 50,000 tons per annum. That would bring our ore in the JV to be mined early in the mine life, and therefore increase the value to us. It is. I think over the last year there has been some aspects of Mexico, as part of their government, looked at sort of to try to nationalize lithium assets, and specifically new exploration assets. And we took the, and we've been in discussion with Ganfeng, their opinion we concur with that, is that doesn't apply to this asset, because the concession was already granted, so it doesn't apply. And I think I really can't say much more than that, because any discussions that Ganfeng are having are commercially sensitive, and once there is something that's price sensitive, we will announce it and put it out in the market and update it. I think. So
what's been the communication from the Mexican government then? What have they actually said about generally about lithium assets?
So they have said that they viewed, I think they classified as lithium as like they did with the oil industry, that they viewed it as a critical metal, and therefore all new, or the way that it was phrased, all new exploration license lithium would be run by a national institute, which was meant to be formed. I think has just formed, but this is not a new license. It's an old license, and it's been explored and developed. And so there's inherent value, and there's a DFS there. And I think in the absence, and this is my opinion only, in the absence of that government decree, there would have been, I think Ganfeng would have started building on this asset. So we would be much more advanced. And until there is absolute clarity, Ganfeng are not going to be, in my opinion, are not going to be, investing large sums right now. So if that's what they've done, the view is that on a legal basis that the license is still valid. And I think, Ganfeng obviously will be having discussions to determine how to progress that. And I remain positive. It is such a large asset, so substantial, and so important that it will get developed. It just might take a bit longer. But let's see what Ganfeng see and announce, and see how they go, and we'll update the market as and when.
Yeah. So that was 2022.
Yes.
A lot of stuff going on there. So let's just have a quick look at 2023. What do you hope to achieve? And also, I want to ask you, what's the most burning question on your Amapa iron ore project that you're getting from investors at the moment?
So in 2023, I think our targets, let's take our primary asset, which is the Amapa asset. We talked about in our RNS, obviously to go to DFS is one of the things that we would like to start with our JV partners. But before then, we saw some opportunities in the PFS. About PFS is also about understanding opportunities that you can improve on in DFS level. And one of the opportunities was, as I mentioned, there was a high capex, or what we thought was a high capex in terms of the port, which was about completing the retaining wall, which was around 80% complete. We could save substantial money there by effectively, and we've already done a trade-off study in the PFS, which has some estimates, which would basically negate the requirement of that retaining wall by moving, in a technical term, basically moving the rail loop back and some redesign of some of the loading systems. That to the port, that would reduce that capex quite substantially, but we need to do effectively what we'll call a PFS level study just on that part. It's not a new PSW across the lot, just on that part, which may save us up to $50 million in terms of capex on that, which then takes us down to 350. That starts even better position. So that's on the cost side. Then the other opportunity we identified was right to the north of our area, the license area. There is a gold mine called Tucano. It's on the same type of geology, and they just mine gold. And historically, these assets were together, and through history and various sales, they got split apart. And there was a joint venture which still exists, where Tucano is allowed to mine gold from our area, which is fine. There's a paid pit called the Duckhead, and they pay us effectively a bit of a royalty, or they pay us a dollar per ton, and we can do the same in terms of iron ore from their area. And in 2011, there was about 900 holes assessed of all the holes of both iron ore and gold drill holes on their area, and they identified a further 150 million tons of material, of iron ore material. Now, between 2011 and now, that may have been depleted, but if we can increase the mine life by, let's say, another 5 or 10 years as a result of that, you could be adding another 100 to 120 million dollars to your NPV, which might not sound like a great deal, but it's actually strategically it's important, because when we look at possibly joint venture partners, when you look at sort of other financing, having a long mine life is important. So those are the two things we're going to focus. First of all, is focus on seeing how much is there, possibly doing some drilling as required to define that new mineral resource, and therefore upgrading the mine life, and doing that study in terms of improving the capex. From that, you'll embark on the DFS, and then after DFS, you will then secure financing and then a build. But that's past the 1 year, the build and the securing the financing. But those are our targets operationally. But it's really important now we have a PFS at Amapa to start looking at the corporate side of it, which is offtake agreements, securing and discussing financing for the project, for construction, possible JV partners at the project level to help fund the DFS, and effectively have an excellent partner there and move this forward. I think we are already, as any company at this stage, would be in discussions in developing those relationships, and that's going to be certainly my focus over the next 6 months, is pushing those forward, and maybe getting to MOU stages and so on and so forth with various parties. But that's really what we're doing there on Amapa, and that will be our focus. And in terms of burning questions on Amapa, I think people sometimes, one of the ones was, why didn't you mention the stockpiles? Because we have still stockpiles there, and it's not in the PFS, because the PFS assumes those stockpiles are being sold and used to pay the secured creditors, and it's not relevant or part of the PFS. The PFS NPV starts from the date of your first investment, i.e. when you start doing the capital investment for construction. So it's not included. Those stockpiles are still there, and we're discussing with the bank so that they agree the disposal, because there is a margin there for us to be able to dispose of that material. But the process we have with the agreement with the banks is they have to agree to remove their security so we can sell that and pay them back. So that's ongoing with the banks to get that done. The other one was, why is it taking so long? You said this was a quick asset to develop. I think people have to understand scale here. if you're developing an asset this size, from scratch without a resource, there's at least a 10-year timeline, or there's a 10-year timeline to develop this, or at best a 6-year timeline. We've curtailed that substantially by already buying something sort of asset construct and all the rest of it. But ultimately, the construction timeline is going to be roughly the same, maybe slightly less than building a new asset, because you effectively have to mobilize the same. It's complex. You have to mobilize the same amount of engineering teams, raise the capital. So those sort of timelines are going to be the same. And DFSs, whether you have a rehabilitated asset or an old asset that needs to be rehabilitated, or a new asset, also takes roughly the same time, because you still have to do the engineering work to the level of a standard of engineering, which is 10% accuracy. You can't take shortcuts. Otherwise, no one will lend you the money for the construction, which is going to be around 80%, depending on iron ore prices. But if iron ore price positive, we'll look to about get 80% debt and 20% equity to construct this asset. On those two assets, on that asset, that's been the two questions that seem to be popping up. And on Sonora, it's really what we've discussed is what's happening there. There's all of this rumor flying around, and I think my best answer I can give there is obviously Ganfeng are in continued discussion with the Mexican government, and our view is that the licenses are valid, and let's see when that progresses, and once it does, we'll make the market aware.
Yeah. Excellent stuff. Well, Kiran, thanks for coming on and say, seems like a lot of potential there, but maybe some patience is needed, not only for the markets, but of course, developing a mine is not a simple thing. Like you said, you can't just switch it on and switch it off, but the potential upside is very large, as I said. But thank you very much, Kiran, and no doubt we'll be catching up in the not too distant future. Thanks a lot.
Thank you, Justin. Pleasure as always.